The Keystone XL pipeline is a 2,000-mile funnel that would pump oil from the Canadian tar sands south to the refineries on the U.S. Gulf Coast. If the $5.3 billion pipeline is approved, what does that mean for jobs? It will create about 42,000 direct and indirect jobs nationwide during the 2-year building phase. Almost 4,000 are pipeline construction jobs. But the pipeline is only expected to create 35 permanent jobs. As for oil profits, a recent report forecasts a razor-thin profit for oil companies. Why? The recent shale boom created a glut of oil in the north-central United States, dragging down prices. But if oil from the tar sands can make it to the Gulf Coast via the pipeline, it competes against the Mexican crude benchmark. That's projected at $89 a barrel in 2015. If it stayed in Canada, the projected benchmark is $69. That's a $20 difference. But not so fast. That $20 premium doesn't necessarily mean big profits. Canada's heavy crude is some of the most expensive to produce. It needs to fetch at least $65 a barrel just to break even. Add in transport costs, including extra lubricants needed to get it through the pipeline. And the profit margin drops to just $5.50 a barrel in the Mexican market in 2015. And if the pipeline doesn't get approved, who are the winners and losers? TransCanada, owner of the proposed pipeline, stands to lose a lot. The company has sunk $2.3 billion into the Keystone project. And companies like Suncor Energy, Cenovus Energy, and ConocoPhillips could also face hurdles getting their product to market. The next best option, railroads. 150,000 barrels of oil a day is moved by train from Canada, and that's expected to increase to 360,000 barrels a day by the end of 2014. But rail is much pricier than the pipeline, and that means rail investors like Warren Buffett could win big. The longer the pipeline gets pushed back, the higher the demand for rail.